Welcome back to the Financial Shepherd podcast. My name is Joshua Casey Garland, certified financial planning professional, founder and CEO of Shepherd Wealth Management. Excited to be back in home studios today for an epic podcast after a pretty epic week in markets here is. So I got a lot to talk about here today. A little bit of an update from the last time we did the podcast, which got a lot of really good feedback, by the way. So certainly appreciate all of those that like, share, and subscribe to the program. Um, and certainly love to hear more of your questions. I've been sitting down with a lot of clients here at the beginning of a new quarter doing their quarterly reviews. And I'll address some of those questions here in today's podcast. I'm already looking forward to the weekend, man. Usually I don't. I love my job, and it's a really great opportunity for me to make a difference in the lives of others. But I got to tell you, this has been one hell of a week here, not just historically, which we'll talk about, but also just emotionally. And that's the major topic of conversation here on the Shepherd Wealth Management podcast. It's what's given our clients a huge edge. It's also one of the reasons why we don't have a lot of people running around, throwing up their hands and just ready to completely give up on anything good coming out of not just the White House or politics in general, but obviously the market and their money. So we're going to cover those topics here today. But as before we dive into that, we got a hell of a week here of basketball coming up as well. You know what the Final Four is looking like. SEC is kind of heavily weighted in all of this. So you got any predictions and thoughts on the matchups?
Let's see. On the men's, I'm thinking it's going to be Florida and Duke, with Florida coming out.
Yeah. Whoa, good
And
call. That's what I told Nicole. She picked Florida to win.
and
But yeah, I have a hard time picking either one of those teams personally.
yeah, well, honestly, I feel like, and this is not to sound like an SEC homer, but the Auburn, Florida, both those teams are really bad matchups for a team like Duke,
Yeah,
and Duke is certainly, whether you want to call Duke your team or not, they've had the easiest path to the Final Four, period, and
sure.
everything was kind of handed to them. The interesting game with Houston, though, I mean, Houston could certainly end up beating Duke. They're that good.
Yeah, yeah.
Women's, I've got South Carolina and UConn meeting in the final.
That's not a shocker, but yeah, it'd be a good
Yeah,
one.
yeah. Well, UCLA and Texas are still 1 seeds, and UConn got in as a 2.
Yeah.
But yeah, UConn and the women's game, first round of the Final Four of the women's is tonight, so I'm looking for that. Starting here in about 3.5 hours from where we're at. So I'm stoked.
I'm ready for a cold one already, buddy.
Yeah,
Gonna need it, but we gotta deliver something here for the people.
let's do it.
Honestly, guys, I didn't want to do this podcast this particular time just because of everything that's coming on here, and there's no real true clarity. But I thought it was important that clients and those that are fans of the program here after a hellacious week and most specifically last couple of days here, I thought it would be important, and I think a lot of others would want to hear, our general thoughts about it. We'll provide certainly some historical data and kind of what to do next after all of this, depending on where you're at with your emotions and your portfolio. So that's coming. And by the way, please like, share, subscribe to the program. For those that are watching for the first time, welcome. The main reason why this has been a successful company for clients, it's not just because we're making them profits and providing a great service, but it's also for programs just like this, content just like this. This is the reason why we are of value to the public or from moments just like today or this week and really over the last 6 weeks. Because what we're really charged with is not only helping people navigate these waters, but Warren Buffett famously said the number one reason individual investors do not achieve the results you're looking for consistently over time is they have no control over their temperament or their emotions. And that's exactly what we spent a lot of time talking about in our last podcast. And that's what we're going to spend some time talking about today. And the reason why this is such an important topic and why we're trying to solve for that problem for individual investors by delivering content as quickly as possible, as often as possible, and as conveniently as possible, right through our mobile app for our customers. They get all this content regularly because I know that they're walking around with smartphones. I know that they're walking around or, at work checking the news here and there. They're probably getting even, push notifications saying, hey, we got all this volatility going on due to the tariffs potentially causing things like inflation, et cetera, et cetera. those are always going to be headline risk, not specifically tariffs, but headline risk is the reason why individual investors have a hard time controlling their emotions. So what we do here at the program is say, yeah, this is something that the news should bring to your attention. This is why they're bringing it to your attention and why you should care. But what the news does a really bad job of, and I understand why they do this, is they're a for-profit entity. I'm a capitalist. I'm looking to make profits as well. So I'm not bashing them for that. But what I do have an issue with, an axe to grind with the news, is that they never come back to you and say, yeah, this is important. This is a risk. This is why you should care. But by the way, just to cool your jets a little bit, we've been through something very similar to this over the last 100 years. Actually, we've been through it about 12 times, and here's what the result was of the S&P's 11 sectors over the course of the next 3, 6, and 12 months following this event that we're highlighting for you here. They won't do that. And the reason why they won't do that, again, there's for-profit entity. They understand this topic called behavioral finance better than any other entity that I'm aware of. And all that simply helps understand. It's just a study that you can get a PhD in pretty much every major university these days. It just helps you understand that human beings are hardwired with these emotions called fear and greed. And we feel losses twice as much as we feel good about making a gain. So we are risk averse by nature. And over the last 3+ years of doing this for clients, we've been through a lot. We've been through inflation scares, we've been through elections, all kinds of different issues. 2022, first full year of being in business. I mean, that was a recession. You just couldn't officially call it that because we never actually had an unemployment rate issue, but every other classic issue of recession, negative GDP, 2 quarters in a row, or negative, et cetera, et cetera. That was all true. That was our first year in business. So there was a lot going on emotionally at that time. And thankfully, because we look at the market through a lens of history and make decisions based on that of how much risk we're going to take and understanding what the reward might be for the given risk taken, that's led us to quite a bit of performance for customers. Certainly help them, get control over their emotions that allow them to see through some of the headline risks that they're actually looking at right now, coming from major news outlets. So I have no problem with the news. I have no problem with them scaring the hell out of you. That's part of their job. But what they're really there for is to make a profit. They're a for-profit entity, which is why they're going to continue to share that information with you, as opposed to saying, some positive things based on current ties to previous events in history. So that's what we're going to get into here today. And really, what I wanted to start with is some hard data. So we got some unemployment or some employment data today, which was really excellent. But that's really just been kind of blown over, given all the other headline risks that we're seeing here today. So I just wanted to kind of make everybody aware as to what has happened here recently regarding some of the most recent hard data facts. And we got it right here. So jobs data has all been ignored given the elephant in the room being tariffs, but certainly was a much better job report than the market was looking for. And that didn't do a damn thing to help improve any of the selling that's actually occurring here in the market today. So, from the numbers standpoint, we got Friday jobs, April 4. So 228,000 jobs actually were announced here at 8:30 a.m. this morning. The market was looking for 140,000 jobs posted. So excellent results there. Unemployment still hanging out 4.2%, slight tick up. U.S. wages came in line 0.3 month over month, and average wages year over year came in just a tick lower, 3.8 versus 3.9. So Fed Chair Powell has already said that the jobs market is not a source of driving inflation. Matter of fact, he had a conversation today with the public at 11:30. This is not an emergency announcement that he had. It was a pre-scheduled thing that was on the calendar all year long. So we all knew that this date was coming for a press conference. So not an official Fed meeting. No interest rate decisions were made. But he did reiterate the fact that the economy looks strong. When you look at all the hard data points, they're still taking their data meeting by meeting and plan to make decisions according to that data as they go along. But they're not going to be making knee jerk reactions, effectively, what he said. due to the headline risk, which is causing a lot of knee jerk reaction for individual investors, not just in the retail side, but certainly on the institutional side as well. So they're not panicking, and they're going to allow the data to come in meeting by meeting and make decisions accordingly. And the next meeting won't be until early May. However, the probability of rate hikes has spiked substantially given all the volatility that we've seen here recently. And just to take a step back in the course of this year, coming into the year, the Fed said they might expect a rate cut or two. But even prior to that, September of 2024, they expected to come into 2025 doing three rate cuts. Late December of 24, the Fed said, well, we're not really sure if we're going to be doing, three or four rate cuts like we had talked about, maybe one or two. That certainly spooked the market, caused a sell off. And as of today, the Fed is still data dependent, taking things meeting by meeting. I do believe that that is the right approach for the Fed to make, because the hard data that they're looking at, that is the only data that they're going to use to make decisions. Fed Chair Powell told you that in the last Fed meeting in February. They flat out said the soft data surveys of consumer sentiment is not matching up with the hard data. This is what we spend so much time talking about in our prior podcast. This is why you want to like, share, subscribe to the program. So your favorite friends, family members, relatives, and coworkers can get control under their emotions and actually make some better decisions here, because this is certainly looking like an opportunity to us here at Shepherd Wealth Management and for our clients. But Fed Chair Powell did say during the last meeting in February that they are factoring in the new policies from this administration regarding things like trade and tariffs. They did factor that into their numbers and their projections. They said a little bit slower growth, a little bit higher inflation, but those things were an offset. So we still expect a couple cuts this year. That was as of the last meeting in February. Well, as of this morning, when we first woke up, the market was pricing in three rate cuts. But as I'm sitting here today with 32 minutes to go until the bell rings at 4 o'clock here and the market's closed for today and the week, those probabilities has now spiked to 5%, or five rate cuts, I should say. So we went from September last year, Fed saying probably three, four rate cuts. December, they said maybe one or two because these policies. Then they come back in here in February and say, yeah, we're still thinking about two plus cuts. And now the market is pricing in up to five rate cuts between now and the end of the year. Because the Fed did also say in their last February meeting that they do not like to see the stock market fluctuate negatively this much this quickly, because it is an indicator for business to either pull back on making investments. And if they pull back on making investments, what typically follows is, well, if I can't make these investments and I'm uncertain about the future, well, I need to start getting leaner, which means jobs layoff. Now, that is not the risk here today, but we're flirting with it, which is the number one indicator of things like recession, which I think that R word gets thrown around way too often. Even amongst the volatility that we're seeing here today, you cannot call recession in any way, shape, or form by looking at the hard data. But if you do look at the soft data, things like the University of Michigan Consumer Survey that we spent so much time talking about in our last podcast, that is showing two extremes depending on where you fall on the political spectrum. Now, this is not a political statement. This isn't a political show. I don't get paid to make any political statements at all. I get paid to provide advice and guidance and navigate these rough kind of waters. But consumers are also investors. And the great thing about the market is investors are also humans. They're also consumers. They might fall politically, Republican, Independent, or Democrat. And the last data that we share with everybody is, consumers, investors, humans, depending on where you fall politically, when asked the question, how do you feel about inflation 1 year from today, you get two widely different answers. If you fall under the Republican category, 1 year out from now, you expect inflation to be zero. If you fall in the Democratic Party, based on the latest survey, you expect inflation to be about 7% almost 1 year out from now. Now, those are two very wide extremes, and current inflation year over year is 2.8. So the answer, generally speaking, in life, when you have two extremes, one party's saying this is going to happen, the other saying this is going to happen, there are two widely different opinions. Usually the answer is somewhere in between. I think we can all kind of agree with that, which would make perfect sense of where the Fed would like to take their monetary policy. Their neutral rate, they believe, is somewhere right around 3%, which means they need to cut interest rates because we're at 4.5% today. And to get down to three, obviously that would imply six interest rate cuts of 25 basis points apiece or a quarter of 1%. All of that is likely not going to happen this year. But that's okay. That would just spread those rate cuts into 2026, which is obviously a really good tailwind for equity markets, and they can certainly use that right now. So the Fed is not going to be stepping in immediately because the hard data is just simply not matching up with consumer survey data, soft data. Now, on top of that, we've had a lot of volatility. It's been a brutal session for equities on Thursday and Friday of this week because investors are grappling with escalating tariff rhetoric. And we saw a dramatic opening gap in the S&P, meaning that the market opened up yesterday on Thursday down 3%. That was the seventh largest opening gap in the past 40 years. And we had it in back-to-back days, by the way. So I'm not sure if this is the seventh or sixth largest opening gap if you throw in today as well. I'd have to go back and check all that. But throughout the session, meaning yesterday, administrative officials such as Commerce Secretary Howard Lutnick and Peter Navarro doubled down on administrative tough stance on tariffs, reinforcing fears that the trade war would intensify. Now, again, if you're in the news and your job is to promote news and make a profit, right? This is make all this stuff real simple. Well, the news is tariffs are going to cause inflation. That's what the news is. We don't all know for sure if that's going to be true because we don't know what products, what countries, and for how long these things called tariffs are going to be in place. We just know what we know coming out of the White House right now. But the market doesn't want to look through any of the what ifs. What if we don't charge this country, or what if this country comes to the table and comes to an agreement? They're just saying, this is all we know. So we're going to price this into stocks right now as though none of this stuff is going to change, which would imply that this market is going to go through 100-year type of correction, like an unprecedented type of death spiral is really what you're seeing here based on these opening gap data points. And the magnitude of the sell-off is drawing comparisons to COVID, which happened in March of 2020, a violent drop in the S&P 500. The federal government had to step in and printed a ton of money. Due to causing investors and business people all over the world to say, hey, there's liquidity here. Even though everybody's going to work from home right now, people have money, businesses have money in their pockets that will keep the economy rolling. And certainly had a great run for 2020 after that. But now we know in hindsight, if you print that much money more than any time in history, that certainly was a major driver of inflation on top of shutting down a global economy for 2 years nearly. The supply chain definitely was a little jacked up as we were coming out of that. So my point in saying and reminding everybody of that event in 2020 was that was a hard data point. Okay. We went through something called COVID where there was no other precedent in the course of history at all. Therefore, we had to shut down the global economy. I don't know if it needed to be shut down for so long. That's up for debate, depending on how you feel about the whole COVID situation. But the reality is, I give them a lot of grace for printing as much money as they did. In hindsight, obviously, we wouldn't have wanted done as much, and probably would have had some other, rules and so forth wrapped around all of that. But when you don't have a playbook for what to do, I give some grace for that, and certainly cause other problems. But you can have a little bit of grace for that. But this is a hard data point. Is the main point. Right now, all we're getting is tariffs cause inflation, and we just increased tariffs the most we've ever seen in the course of mankind history, at least in a century. And that's all the news wants to run with without providing any other context to it at all. And I don't necessarily blame them because I bet that they're probably getting more eyeballs on the screen and their ratings are probably better than they ever have been over the course of the last several months or maybe even years because this is the only thing that anybody wants to talk about. It's certainly on the minds of investors and politicians and companies. And by the way, we're about to go into Q2 earnings season, and this is for sure going to be on the tip of every CEO's tongue as they go throughout their earnings announcements. But if we take a step back here and think about Why are we doing this? Number one, I think the obvious answer is trying to get a better opportunity for US businesses to do business more globally in a more fair way. I can understand that. But what do we know for sure that these individuals do not want? So, part of being, let's say, a really good test taker is you're able to eliminate answers, right? Because it's just putting the probability of you getting the right answer in your favor. I think everybody would agree with that. So, you can also use the same logic in this particular circumstance here. What do we know for sure that this administration does not want at the end of the day? And no administration would want this, by the way, whether you're Republican, Democrat, Independent. No administration wants to be a one term Congress man or woman. Nobody wants to lose the ability to move forward with their agenda. In other words, they don't want to lose power. We can all probably agree on that, whether you're Republican, Democrat, or Independent. That is probably a fair statement to make that your party would not like to lose power during a midterm election when you are in power, right? So if we know that to be true, the only thing standing in the way, at least at this moment in time here in April of 2025, is if this administration, due to policy decisions, tariffs, trade negotiations, that is what is potentially going to bring us on the brink of or into a recession. Because again, none of the hard data points would match up with that R word, recession. Unemployment rates in check. Corporate earnings last quarter were phenomenal. Corporate earnings expectations outside of this specific issue that we're talking about here today called tariffs is not in question. And inflation's been falling, and the Fed's telling you that they're planning on cutting. So there isn't a macroeconomic backdrop that brings you to this plus this equals recession. No, it's the policies that are being implemented today and the news running with the headline that's causing this particular sell off that you're seeing here in the market. There is no other reason for it at all. This sell off matches the consumer surveys, which is soft data, and their questions of, hey, how would you feel? How do you feel about the tariff policy and what that'll do to things like inflation 1 year out from now? How do you feel about the economy 1 year out from now? And depending on your bias, because we're all humans, we have those. Nobody would argue that you're going to feel one extreme or the other. And we just talked about it. And it's been showing up in all of the consumer data, but in none of the actual hard data. This is very unfortunate, of course, because as you go into 2026, if we do, in fact, go into a recession, well, the one thing that you can say for sure, if you're on the other side of the political aisle, is your campaign is going to be very simple. It's going to be, hey, these folks caused a recession. They caused you a ton of pain. And the question is why? Because none of the hard data before they started to make these decisions, unemployment was in check, corporate earnings were nothing but phenomenal. Prospects for growth look good. Fed was going to be cutting rates, and we had to go through what kind of pain and recession relative to the stock market? Oh, it was because of their dumbass decision to go ahead and implement a policy that caused this particular trade war. I mean, that is the message. Regardless of how you feel about the administration, the policies, how they're implementing it, the process involved, whatever, that's going to be the message. And you're going to lose power. So if we know that that is an answer that we can eliminate, we know for sure they don't want that. Well, then ultimately, what's going to happen in quick order is you're going to have to come to the table and come to some sort of agreement with these major countries such as China, Europe, Mexico, Canada, and others, so that the news doesn't have this as the headline risk anymore. And we can come back and say, oh, well, how are jobs looking? Still good. Nobody got let go yet, thankfully. Therefore, corporate earnings should be really good. That can continue. That's great. And inflation, where's that at? Oh, it's still coming down. And the reason why we can kind of hold on to that hope is you're seeing things like the price of barrel of oil fall substantially along with the stock market, hanging out right around 61, 62 bucks a barrel right now. And the last time we did this podcast, it was right around 70 bucks a barrel, which is still damn low. Okay. So it's going to be really hard for inflation to spike if we're no longer in this tariff negotiation and the price of oil is hanging around 60, 70 bucks a barrel. So all of those things are checked. Now we don't have this headline risk. And what can we look forward to next? That's right. We got tax cuts on the table here. and some deregulation, that would lead to a substantial V-shaped recovery. All the things I just laid out there, but all of those things are going to happen sooner than later because the truth is, I don't give a damn if you cut taxes to zero and roll back every regulation. If you run the economy into a recession for no other reason other than the fact that you wanted to have a better trade deal, that's fine. There should be a much better communication like, hey, we're doing this for this reason because we think we'll get X, Y, and Z out of it. And that's why it's good for the American people, specifically in this sector, et cetera, et cetera. Their messaging could be better as they're going about the process. In my view, whether you agree or disagree, communication provides clarity. The market likes clarity. They don't like uncertainty. And they might say, well, the reason why we're holding some of that rhetoric back is, we don't want to give away our negotiating posture, our leverage. That may all be true. But here's the rub is you have all these other countries, Mexico, Canada, China, European Union. I can go on a couple others, Vietnam. They're all of their individual brokerage exchanges, their stock exchanges, they're smoking the S&P, which doesn't make any damn sense. But specifically, Mexico is up 17% on the S&P 500 year to date. That makes no sense. Well, let me tell you why that doesn't make any sense. We have by far the largest economy from a GDP perspective. We're running about a $40 trillion economy here in the United States. I'm rounding up a little bit. Mexico, not even close to the same size as United States. Let's call it about a quarter to a third of the size of the United States. And their market is smoking the S&P 500 so far here year to date. That would imply that these other countries or investors around the world don't see a prolonged trade war, as the news is throwing out here, because certainly they would suffer more economically than the United States would. And let me explain that for you as well. The reason why this administration sees our economy in that same light as leverage for negotiation is this simple fact right here. When you're a larger economy, your supply chains and your partners are more diverse and broad. It's easier for us to pivot. And because we're larger, we can absorb things a little better, actually, much better. Generally the reason why we come out of recessions or things like COVID 2020 events much faster and healthier than a lot of other countries. That's very true. Part of that is the fact that we have way more banks as well. I mean, there's a lot of the reasons for that. That's one. Number two, you cannot replace the US consumer. All of those other countries, pick one, doesn't matter. Their general supply chain is geared towards satisfying the demand of the US consumer. Help me understand where you're going to replace the US consumer's consumption. You're not. So the fact of the matter is, you have a smaller economy and you can't replace what we do here in the United States from a consumption standpoint. What do you think is going to happen? Let me just ask that question to the audience here. I'd love to have your feedback. You can either hit me up at 513-630-2664. Go to shepherdwm.com. You can find all the ways to send me emails, phone calls, and text. I'd love to hear your opinion on that. But you just simply cannot replace the U.S. consumer, and you're sure as hell not going to do it quickly. So that brings the question is, why is your markets, your stock markets, Mexico, Canada, China, European Union, Vietnam, and others are smoking the S&P 500 from a performance standpoint? Doesn't make any sense. Okay. And you also have soft data points not matching up with hard data. So to me, this is highly emotional. The news is doing a great job of flaming the fire. But inevitably, just like COVID, when we solve the pain point by printing a lot of money, this can also be solved not only with an agreement with another country. There's a lot of ways that this can be solved. It can be solved in an instant. It can be solved with a tweet. Therefore, if you have not been participating in any of the market for whatever the reason so far this year, congratulations. You've been right. I would say a little lucky, but that's okay. I'd rather be lucky than good some days, a lot of days actually. Nothing wrong with that. But if you're looking at the market now and saying whether or not I'm at the bottom, should I step in? I don't know if this is the bottom or not, but there's definitely a great opportunity to start dollar cost averaging in because it's one of two outcomes here. You're either going to come to some agreement with all these countries and all this fear is gone And then again, you're going to look up and say, well, where's inflation? It's gone. Unemployment rate, that looks good. What about corporate earnings? They're holding up. What's coming down the pipe? Deregulation and tax cuts. All right, I'm not worried about tariffs anymore, obviously, because we're good now with all these other countries, let's say. Market's going to bounce pretty hard, violently. Don't know when, don't know how long it's going to take to get your money back to where you were on February 19th before all this selling happened over the last 6 weeks. Don't know how much higher the market will go exactly. But if history has anything to say about it, forward returns based on similar events, you're looking at about a 21% result on average. And we talked about this during our last podcast. This is one of the top 7 most violent pullbacks in the history of the stock market. What were the other 6 times looking like? Well, back in 55, Eisenhower had a heart attack. Market sold off substantially and recovered very quickly. We had Cuban Missile Crisis. We almost had a direct nuclear war with Russia during that time. That's a hard data point. Korean War, Trump 1.0. Those were tariffs the first time. And by the way, that first Trump 1.0 administration, when tariffs were the main cause of volatility in the stock market, then I could understand that because that was the first time in a century plus that we can make any comparison to a similar policy regarding tariffs and trade. Some people said Reagan, but he wasn't not even anywhere close to pushing this agenda anywhere close to this administration. So again, 100 plus years, that's a hard data point. That would make some sense to me in causing fear and uncertainty in the market. Obviously, we know the result was from that. There wasn't any inflation. It was a great 4 years of performance in the S&P 500, led by technology, consumer discretionary, industrials, and finance. And those are the 4 sectors getting smoked the most. Our bet is those are the sectors that are going to be the major outperformers, and we're still calling for double digits in 2025 because, again, my premise is I do not believe that any administration that has the White House, um, Senate, Congress, the whole thing, they don't want to lose power. I don't care which side of the aisle you're on. If you're in that scenario, you don't want to lose it. If they don't want to lose it, they better not cause a recession because right now they're flirting with it, right? But this can all be changed in a tweet, in a public address announcement with one phone call. Okay. And we could be in a really great place afterwards. But right now, as we're sitting here today, Friday, April 4th, nearly 4 o'clock Eastern Standard Time, is your favorite index here. You know what it is? The AAII Net Bulls.
Love the AAII net bulls.
I know it's on your uh, computer 24/7.
Yeah, I got
Six,
merch. I got a bunch of merch.
almost a 62% bearish. I mean, this is the third highest bearish reading of all time. Of all time. Bullish response is only 21.8%. So if you've been sitting in cash or something similar to that, I would highly recommend for at least a portion of your portfolio, even if you're very risk averse. This makes some sense in stepping in dollar cost averaging, putting a little bit of money to work, let's say on a weekly basis, up until you're getting to the place where you really want to be as far as participating in the market. If you've already been participating in the market, as we have all year long, you've kind of had a tale of 2 halves here so far this year, from January 1 through February 19. If you were a participant in the market, let's just say you bought the S&P, you're up 4%. Our clients were up about 8. Last 6 weeks, sell off. So what do we do? Well, again, this is part of the reason here at Shepherd Wealth Management, we believe that it's very important to solve the biggest problem that individual investors have, and that is controlling their emotions, so they can make better decisions and get the kind of results that they're looking for consistently over time. We want to sit down with them every single quarter. We want to get this information in their hands as fast as possible, as often as possible, and as most conveniently as possible through our mobile app. So we sat down with them at the beginning of January and said, hey, look, we expect a great year. Here are the reasons why, historically and fundamentally. Here's our expectations for growth. And we're going to hold ourselves accountable to that because you're a growth investor. But we do recognize there will be changes. New administration always does changes, and therefore there could be some volatility. And we came into the year with an allocation towards a lot of broad-based ETFs, some individual stocks, broad-based corporate bond ETF as well. And even though we were much more risk averse coming into this year, although still participating, we're still doing a great job of outperforming right before all the sell off happened. Now, as we're going through this sell off, What are we doing? What am I encouraging folks to consider doing if you have been participating and you are a long term growth investor, meaning that you are comfortable with volatility for the opportunity to participate in longer term gains? This is a part of that. And what I would encourage doing is if you have some of those positions like we did, very broad based, diversified types of positions, ETFs, we're selling those slowly, and we're using that capital to invest into stocks in those same sectors that we really wanted to own anyway as we came into the year. But now we're getting the opportunity to do that at a much larger discount, and we will continue to do that all the way up until the point where maybe the hard data starts to marry up with the soft data, and then I'll have a completely different perspective on what to do regarding positioning and asset allocation. That is the encouragement that we have. Now, when we come back to this tariff conversation, again, I just mentioned that yesterday, Thursday, was the seventh biggest gap drop in the S&P 500 at the open of all time. We have the third largest bearish reading in the AAII net bulls of all time. We back that up again today with another 5.5+% sell off in the S&P 500 and another 3+% gap drop in the S&P right as we began the day, because we had a reciprocal or retaliatory tariffs coming from China to the US beginning April 10th. It's funny that that's one day after April 9th. So I do believe deals will be struck. But if you're a nation right now and you're sitting here looking at all this, you have a couple different options. You could retaliate, take new measures, but then you got to have the staring contest, like I talked about, with a country that's much larger than yours from an economic standpoint, and with a pool of consumers that you really need to sell to. So I get the China retaliatory tariff. They're our biggest competitor economically, militarily, and so many other ways. But they're definitely more vulnerable to um, economic downturn now than they ever have been in the past. But we'll see how that plays out. My guess is the two biggest economies in the world aren't going to want to hit each other in the head with a hammer every day. So you could retaliate. That was part of the reason for the big drop here today, this morning. You could do nothing and just, let this be the new normal. Doubt that's going to happen. Why would you do that? Or you can negotiate. Those are the three options. And it looks to me, based on the news here from earlier this afternoon, is that there will be, appears, some sort of agreement with Vietnam. So there's one country that looks like there's already come to the table and have some sort of agreement here with this administration. I'm looking forward very much to an actual press conference announcement. Hopefully, it's involving more than just one country at this time, because that is the only thing this particular moment in time that's hanging over the market and causing a lot of pain, obviously. But on top of that, as we come into early April, as I mentioned or started to mention, we're about to come into another earnings season. And another problem for the market is that if CEOs and CFOs are not providing any guidance regarding the future of their corporate earnings, it's going to be really hard for markets to price in what those results might look like. Therefore, we have no real clear understanding of what their share price should be. Although I would say quite a bit of bad news is already getting baked into the cake here very heavily. So this is one of two things. This is either the new norm, which will certainly cause recession and one of the deepest, most painful economic outcomes that we'll actually experience, probably maybe in your whole life, potentially, which is kind of how the news is portraying it in some ways. They're not wrong. It could happen. Or this is a very much a negotiating opportunity that could be very prosperous. And I'm leaning obviously towards that camp because my focus is on the human being and trying to understand what they're really trying to get out of this. And I know for sure that once humans are in power, they'd like to stay in power. And well, the only way to do that is to avoid things like economic meltdowns. So we're dealing with some pain right now, folks, and that's my take on it. That's what we're encouraging clients to do, is to look at what history had to say under very similar circumstances and the recovery thereafter. That's what should be something to look forward to. When you look at this from a more of a common sense perspective and saying, okay, well, how would any human being behave if they were in this situation? and what they want to get out of it long term. I think we've kind of covered that pretty well. And also talked about some of the historical data points here. And really, that's all we have here today, folks. There could be other topics, I'm sure, questions that people may have for us. Love to hear them. But we've spent, I don't know, as what do you think, 2+ weeks sitting here focusing on all the things that we're sitting here talking about today. And definitely don't have a lot more to add to that other than I'm looking forward to any positive news um, coming out of the White House, both this afternoon when the market closes here in just a little bit, as well as over the weekend. So, more to come from us as we get more and more data here. We'll try to do this about every 2 weeks. So, please like, share, subscribe to the program. If you're getting some value out of it, love to hear from you. You can leave a note right here in the YouTube chat. Or you can also find us at shepherdwm.com and communicate with us all of your questions, comments, concerns, any way that you see fit. And again, my name is Joshua Casey Garland, certified financial planning professional, founder and CEO, Shepherd Wealth Management. Wishing you guys a great weekend. Happy March Madness, Final Four, and we'll see you guys in a couple weeks. Take care.